Everyone asks the same question. A bank offers 3 to 4% and here's 19 to 25%. Private credit is not an excess story. It's a cash flow story. Every loan on the platform is backed by real assets. This isn't trust in a team. It's trust in code that has been externally reviewed. Hi, my name is Alec, and today's topic would be first 30 days on 8lends. Block 1. They open the app and they start waiting. They wait for movement, they wait for a sign, they wait for something to happen on its own that confirms, yes, that decision was right. It's not panic, it's simply not knowing what to look at yet. And that's completely normal, especially if you're used to instruments where the whole picture is visible in real time. Price, candles, and red or green portfolio. 8lends is built differently. There are no candles here, no price jumping up and down every 5 minutes, no market noises that many people have gotten used as a background soundtrack to the workday. And that's exactly why the first 30 days are not a period of waiting, it's a period of understanding. Today I'm going to walk you through what actually happens in the first month, what you should be seeing in the app, what should be in order, how the internal protection works, and what you shouldn't waste a single second of attention on. This is complete onboarding, no marketing, only mechanics. Block 2. How 8lends actually works. I'll start with mechanics because without them everything else just hangs in the air and doesn't mean anything. 8lends is a crowd lending platform. Simply put, it connects real businesses that need capital to grow with investors who are willing to lend that capital and earn interest in return. No banks in the middle, no unnecessary layers. The businesses on the platform are small and mid-sized companies, not pre-revenue startups, not venture ideas on a napkin. These are operating businesses with real cash flow, manufacturing, logistics, trade, equipment-driven operations. Companies that need money not for a dream, but for a specific operating cycle. Here's a simple example that shows the essence. Let's take a real project from the platform, Evolve Ways Limited in Nairobi, in Kenya. They install production lines for the food industry across East Africa. Concrete situation, they sign a contract with Premier Foods, a major Kenyan FMCG producer, to supply and install a water and syrup bottling line with a capacity of 3,000 bottles per hour. The contract value is 1,058,000. Signed, real. The problem is simple. Equipment suppliers need to be paid now, while the final payment from the client arrives only after the line is installed and accepted. That's time gap between paying suppliers upfront and receiving the client's payment later is exactly what 8lends finances. In this case, a 750,000 loan in 3 tranches tied to specific project milestones. 8 months, 23.1% APR, risk scoring A, credit history 8/10. The business is clear, the contract exists, the cycle is readable. That's where your interests come from. Another example, real project on the platform, Oryx in Paraguay. Industrial Bitcoin mining. They currently operate at 2 MW and want to expand to 8 MW, meaning they need to buy and import more than 1,700 miners, clear customs, and install the equipment. The equipment doesn't wait, and banks take months. 8lends closes the gap. For that access to capital, the business is willing to pay 23.1% APR. And that's why this rate isn't market-based, not fantasy. Why 19 to 25% isn't a promise, it's a math. Everyone asks the same question. A bank offers 3 to 4% and here's 19 to 25%. So is the risk enormous? No. These are different markets with different logic. Banks work with large corporations and government structures, long track records, collateral everywhere, and powerful enforcement levers. Small and mid-sized businesses often don't exist as borrowers in that system. The bureaucracy is too heavy and the processes aren't designed for them. So you get a credit vacuum. A stable operating business can't get funding not because it's bad, but because the system isn't built for it. And for access to capital inside that vacuum, businesses pay a high rate. Second factor, speed. In business, missed opportunity costs money. If a construction company wins a tender, it needs materials now. Waiting a month for a bank decision can cost the entire project. So businesses pay more for money that arrives fast. That's the price of speed. And the third factor, the most important for investors, when there is no bank intermediary in the chain, the margin the bank would normally keep is transferred directly to the investor. Same credit economics, different recipient of the profit. Block 3. The first 30 days. What you see and what it means. Days 1 to 7. Money is in, but nothing moves? That's normal. You top up your balance, you open the app, the money is there, but nothing happens. No loan notifications, no movement. The first thought is, something went wrong. Nothing went wrong. This is a normal allocation stage. The platform routes your funds into loans that have passed verification and are in an active funding phase. That is not instant. Each project raises funds in stages. There is a minimum threshold and a maximum. Until a project reaches the minimum, the loan doesn't activate. Once the threshold is reached, funds are disbursed to the borrower and interest starts accruing from that moment. That's why a few days can pass between topping up and seeing your first accrual. Your money is waiting for a specific project to activate. What you should do in the first days: go to the project section and look at active loan cards. You'll see real companies with a name, country, loan amount, term, rate, and a clear use of funds description. These aren't abstract numbers. This is the business your money is going into. Open 2 or 3 projects and read the description. It changes your perception of the product. Also, notice the buyback badge on some projects. I'll explain in details later. It's important. Days 7 to 20. Your first accruals appear somewhere in this window. You start seeing your first accruals. They are small, sometimes they feel too small. Here is what you need to understand about the nature of this income. Unlike a bank deposit where interest might accrue quarterly or only at the end of the term, on 8lends, payouts come monthly, regularly, predictably, on schedule. This isn't slow yield, it's simply a different rhythm, not market rhythm, but credit rhythm. If your funds were deployed mid-month, you typically see your first payment about a month later. Once the first full accrual period closes, not earlier. That's not a delay and not a problem. That's how the monthly cycle works. A stable, full picture usually forms in months 2 or 3. Once the loan in your portfolio settles into a normal cadence. What else matters in this period? Watch your portfolio section. How many active loans do you have? How many borrowers are your funds spread across? The more position, the better the diversification, and the lower the impact of any single borrower on the overall picture. Days 20 to 30. You see the first complete picture. By the end of the first month, you have enough data to make your first meaningful observation. Not conclusions, observations. First, did your first interest payment arrive? Not how much, the fact itself. If it arrived, the loan is active, the cycle is running, the system works. Second, does what you see in the app match what you were told on entry? Same rate, same project, same terms. It should read the same before and after. Third, are payouts coming on time, not earlier, not later, on schedule? That's the simplest real-world reliability check. If all 3 points are in order, your first month went correctly. The system works, and from there it continues without requiring your active involvement. Block 4. How your money is protected and inside breakdown. This may be the most important block, because understanding protection is what separates an investor who calmly holds a position from someone who gets nervous at every market sneeze. At 8lends, protection works on 2 different levels, and they are not interchangeable. That's important. Level 1. Real collateral, RWA. Every loan on the platform is backed by real assets, not promises, not future revenue, not tokens. Physical objects with market value. This can be industrial equipment, vehicles, warehouses, real estate, things that exist and can be sold. The key metric here is LTV, the ratio of the loan amount to the collateral value. If the loan is $750,000 and collateral is valued at $1.5 million, the LTV is 50%. The lower the LTV, the larger the safety cushion. This is a number worth checking in every project card. Who controls the collateral? Maclear AG, a Swiss company registered in Basel and a member of Polyreg SRO, a self-regulatory organization supervised by FINMA, Switzerland's financial regulator. This status requires strict standards of due diligence, AML, and transparency. Maclear AG legally registers the collateral, verifies the asset exists, and matches the declared value. If a borrower stops paying, Maclear AG initiates enforcement, valuation, asset sale, and distribution of recovered funds to investors pro rata. Before a project appears on the platform, Maclear runs a multi-layer review across 40+ criteria: financial history, credit rating, business structure, collateral liquidity, legal cleanliness. This is not a formality. The business undergoes a paid audit at its own expense. The logic is simple. A company that isn't willing to invest in proving its transparency is usually not ready for long-term obligations to investors. That's why most applications are filtered out before you even see them. Level 2. Buyback guarantee. The badge that changes everything. Some projects on the platform carry a buyback badge. This is not a marketing sticker. It is a legal obligation from a third party. Here is how it works. If the borrower delays payments by more than 60 days, a specialized partner financial company in Moldova, under a master agreement with the platform, buys out your debt and returns 100% of your principal, meaning the original amount you invested. Any interest you received before the delay remains yours. Nobody takes it away. Let's put numbers on it. Suppose you invested 5,000 USDC at 20% APR for 9 months. Monthly income is about $83. You receive payment for 5 months, that's about $416. On month 6, the borrower fails to pay. The counter starts. On day 61, buyback activates automatically. The partner returns your 5,000 USDC. Your $416 earned interest doesn't disappear. Result: you didn't lose principal and you earn real profit even in a default scenario. That's a fundamentally different level of calm, not because there is no risk, but because for the investor it's structurally addressed. Projects without buyback are not unprotected. Their protection works through the RWA mechanism with Maclear: collateral, valuation, sale. It's a longer but predictable process. That's why for a beginner in the first months it's logic to prioritize buyback projects until you learn to read project cards and assess LTV more confidently. Smart contract and audits, transparency at code level, and more things worth knowing. The platform's smart contracts have undergone full audits by two independent firms, Certic and Cyberscope. These are recognized names in Web3 security. The audits validate the correctness and fund allocation logic and data integrity. In practice, this means distribution happens automatically according to the embedded logic, without manual intervention. The platform's operational entity is registered as Alpha System LLC in St. Vincent and the Grenadines. This legal entity is responsible for smart contract execution. You can verify this technically. All transactions are public on-chain. This isn't trust in a team. It's trust in code that has been externally reviewed. Block 5. How to understand a project in 2 minutes. When you open the app and see a list of projects, the first impulse is to look at the APR. 19, 21, 22%. That's a decent starting point, but it's not the only number that matters. Here's what to check to understand a project's essence in a couple of minutes. First, why does the business need the money? Specifically, not for growth in general, but concretely, are there signed contracts? Is the cycle visible? Buy, sell, repair? If yes, it's a working mechanism, not fantasy. Same logic as wholesale electronics. Contracts are signed, buyers are known, the cash gap is clear. That's a readable story. Second, LTV and collateral type. Low LTV with liquid collateral is good sign. High LTV or exotic collateral is reason to spend more time. Third, long term. Short-term loans, 4 to 12 months, means faster returns of capital and more predictable cycle. Longer terms can carry higher APR, but the capital is committed for longer. Fourth, is there buyback? We already covered it. For beginners is the first things to prioritize. All of this in every project card. You don't need to be a financial analyst to read it. You just need the habit of reading, not only staring at the APR number. Block 6. What else the platforms includes? What you should know. Bonuses for your first investments. When you register and make your first investment, the platform gives you a 30 USDC bonus. This is not a marketing trick, it's real funds added to your balance. Check your account to see whether the bonus is activated. Referral program. If you bring another investor, you receive 6% of their investments for 45 days. That's real money you can reinvest. You can generate your referral link directly in the app. 8lends token, cashback on investments. Another ecosystem element is the 8lends token. With each project investment, you receive 6% cashback in these tokens. This is not mandatory for your strategy. Treat it as an extra layer on top of your main interest income. Important, don't mix this up. Your core return is USDC interest from loans. The token is a bonus tool. You shouldn't build your investment thesis around token appreciation, but receiving it as a cashback while loans are running can make a sense. For context, since listing, the token has grown by more than 1000%, but that's market performance, and by the time you're watching, the number may be different. Check the current chart via the link in the description. Block 7. The right framework. How to view this type of investment. When someone invests in a stock, they expect price movement. When someone buys an apartment to rent out, they expect rental cash flow. When someone works with private credit, they expect stable interest from a real economic cycle. Those are three different logics. The mistake people make is applying the logic of the first instrument to the third. They look at the stable credit product and search for crypto-style price action. They compare the first 2 weeks of private credit to a month when Bitcoin pumped 30%. That comparison is meaningless. Different return mechanics, different risk, logic, different time horizons. Private credit is not an excess story. It's a cash flow story. Its strength is predictability and compounding. Reinvested monthly interest compounds in a way that after a year or two looks completely different from what you see in the first 30 days. That's why the first 30 days are not a yield test. They are a period where you confirm three things. Your funds are allocated and working. Accruals are arriving and the system is transparent. You understand this structure, not because someone told you, but because you read project card and saw the logic yourself. If those three things are true, your first month went the right way. Block 8. Summary. What to do right now. I intentionally didn't talk today about specific yield numbers as promises, because it depends on your allocation, your project mix and terms. But I did talk about what's more important: structure, internal mechanics, protection, and logic. If you're already in, you now have a map for month 1. Watch allocation, read project card, pay attention to buyback. Don't compare this to crypto over a short horizon. Give the system time and it will do what it's built to do. If you are still deciding, treat what I shared as a checklist. Real businesses, real collateral, legally structured protection, a Swiss collateral agent, code audits by Certic and Cyberscope, 8 million financed, 0 defaults. This isn't a story, it's a platform stack. The 8lends link is in the description. The FAQ on the website is there too. That's where I took part of the material for this video. I recommend reading this section on buyback and borrower section. It's good reading for an evening. Visit our website where all our processes are explained, and check our Telegram channel. There is a lot of useful information there. Thanks for being with me. See you next time.